All right, everyone in the class, very good morning. Welcome to the session. All right, all the live people, welcome to the session. All the recorded people, welcome to the session. Kindly confirm if I am clearly audible, visible, or not. Everyone, can you very properly see me, hear me? Please tell me. Surya, very good morning. Other live and recorded people in the class, very good morning. Give me a second, let me set the camera a bit more. Yeah, it looks good now. Yes. So everyone in the class, very good morning. Wishing you all a very happy Dashera. Everyone, are you people all there? Please tell me. So, everyone, Srivastav, is that your first name? Srivastav, is that your first name? Very good morning. So, sir, let me take you all back to the discussion we had in lecture 1, right? All those students who have been watching this lecture directly on the website, on the YouTube, sorry, let me tell you, I'll put the link of lecture 1 in the description of this video. From there, you can first watch lecture 1 and then continue to watch this lecture, right? This so that you also get an intro. Most importantly, why I'm asking you to watch lecture 1 of this power batch, because you get a sense of, you get an intro of what this batch is about, right? So let's everyone get started with second lecture of this very short duration but very impactful batch for the attempt of Jan 2026 and onwards in full English language. Perfect. So let me very quickly take you all to what we had discussed in the last lecture, right? To summarize, to conclude for you, to very quickly revise, what we went through was there are different models. Everyone in the class, are we all ready? Shall I start? Come on. Aksa, very good morning. Atulya, very good morning. All the live people, all the recorded people, are we all ready to get started? Come on. Do we have those needed energies? Or the life is all dull and boring? Come on, yaar. Come on, come on, come on. So I know you people don't understand Hindi, but do you know what is the meaning of the word yar? Yar, Y-A-R. Do you know the meaning of the word yar? Let me figure out a few things. Because I'll make sure that by the end of this batch, I'll teach you at least a very few Hindi words, which I regularly keep on using. Surya, you don't know what is yar. Who else? Good morning, Sarvendra. Atulya, do you know? Everyone in the class, do you know what is the meaning of the word yar? Yes or no? Come on, people. Yar, everyone in the class, let me tell you, is a Hindi word which means friend. Friend. Alright. Now, when you say friend, the way we use this word is like bro. I don't want to do it, bro. I don't want to do it, yar. Bro, understand it. Yar, understand it. Oh, bro. Arey, yar is one in the same. Are you people clear? So when I use this word yar with you, you have to realize what do I mean to say. Alright. This was the first learning for the day. Now we start with AFM. Cool. Done. Done. So everyone in the class, we were trying to understand the different ways of valuing the share, right? In the exam, I'll talk this, we are so exam oriented in this batch. So these are all possible models on which the examiner may ask you to value the share, right? Value the business, value the company. The first model was dividend model, where we say that value of a share today is the present value of all future cash flows. primarily all future dividends discounted at the rate of K. To calculate the present value of future cash flows, I need a discounting rate, which is what? K. So first thing you learnt was this fundamental principle, that present value of future cash flows. The next thing you had learned that the value you calculate is called as intrinsic value, fair value, equilibrium price, and the value so arrived, so calculated, is used to compare it with the market price per share. If the price in the market is more, we say the share is overvalued. If it is less, we should say the share is undervalued. And if it is equal to the intrinsic value that we calculated, we say it is fairly valued, and we are supposed to hold that share, at least theoretically. Practically is a different story. Fine. Then we learned that, sir, when it comes to discounting the future cash flows, there can be two possibilities that we might face in the exam. First, sir, I can have a share given to me, which I am holding for a definite number of years, for particular number of years, like 5 years, 7 years, 10 years, or I may be given a situation where I'm holding the share for an infinite number of years. What difference does it make? Everyone, I said when you hold a share for some particular number of years, you will continue to receive the dividends till that number for those years, and at the end of those years, I will have the selling price of share to be received. So present value of all these cash flows, right from dividend of first year till the dividend and the selling price of the last year, I have to discount everything using K, and that become the value of my share. The point to observe was the first dividend to discount is D1 and not D0. D0 is never discounted. It is already at 0 point. It is not the part of my value. For me, the value of a share is the present value of future cash flows. What is my first future cash flow, everyone in the class? D1. Yes. Then we learned, sir, if it is till infinite number of year my holding period, if it is, then value of a share is the present value of dividends to be received till infinity. Which means right from D1 till the dividend of infinite year, present value of all those infinite number of dividends is the value of share today, again discounted at the rate of K. So the present value that you calculate is called as intrinsic value, or interchangeably I can also call it price. Logical word is intrinsic value. However, if I assume the share to be fairly valued, if I assume the share to be fairly valued, then can I say the intrinsic value is equal to price, which is why we and the examiner uses the word interchangeably, the word intrinsic value and the price. Correct. Sir, now when it comes to discounting the infinite number of dividends, how do we do it? Sir, we have to use math, we have to use the dividend discount model, in which you had learnt the first thing, right? And second thing, zero growth model you had learnt, constant growth model you had learnt. The point I was trying to convey is that you have to use dividend discount models, correct? Sir, when it comes to discounting using KE, KE can be first calculated using CAPM, then Gordon's formula, and then earnings yield, right? Then we also learned that, sir, required and expected rate of return are actually two different things. Required is how much I require to earn, expected is how much I think I'll be able to earn. These two things are logically different. But when we go to portfolio management, the chapter of portfolio management, every single of you will learn in detail that when the expected and required rate of return become equal, the price and intrinsic value of the share become equal, which means you can say it otherwise, when the share is fairly valued, that is its price and the intrinsic value are same, its required and expected rate of return are the same. Are you all please understanding it, everyone in the class? Yes. And which is why we don't have to worry about if the examiner is giving expected or required rate of return in the exam hall. All we have to do is, All we have to do is to use that given rate as a discounting rate. Moving ahead, everyone in the class, you learnt that which model exactly to apply depends on the nature of dividends. If the dividend has zero growth, we have constant dividend every year, then the formula is d1 divided by k will give you the intrinsic value. I have not used any other formula except the basic logics of present value of time value of money concepts. Then the next formula is constant growth model. We say the value of a share is d1 divided by k minus g. More than understanding the derivation of this formula, it's important to understand what are these formulas doing. These formulas, everyone in the class, please realize when you apply these formula, what are you actually doing? You are discounting all the future dividends right from D1 till D infinity. You are discounting everything, bringing them to 0.0 at the rate of k, and the value so arrived is called as intrinsic value or price at 0 point. Yes. Then we went into the detailings. Sir, we said the first dividend is D1 is not D0. However, in the absence of D1, you can say D0 into 1 plus G. Second was, despite the first cash flow being D1, the price arrived is at 0 point. Agreed, sir. Third, we learnt if the question is silent, not clear, assume the given cash flow to be D1. Fourth, sir, what matters to me is the growth, but growth of what? Revenue, earnings, or dividend? We said dividend. And sir, that to growth from which year to which year? Growth of 0 to 1 may be anything, but growth from 1 year to infinity is what will matter to me. The growth should be constant every year till infinity. Right from which year? From 1 year to infinity. Sir, in the absence of information, can we assume the earnings growth to be same? To be equal to the dividend growth? The answer is no. If the payout, how many of you remember this particular thing we learned in the last lecture? Everyone in the class, please, अगर आपको रिविजन कनेक्ट हो रहा है तो you have to, without a thought, like this particular video. Come on. If you are able to connect to the revision that we had in the last class, the number of likes will actually tell me that you are able to revise and will tell YouTube that okay, the video seems to be good enough for me to work. This is what the algorithm of YouTube will think. Come on, everyone in the class. Are we all set? Jokes apart, in the chat box, everyone, are you able to connect to the thoughts which are going on? Come on, tell me. Come on, everyone. Oh my God, some people are sending hearts, like blowing hearts. Fine. Let's proceed. So Srivastav, you said, Srivastav, what's your first name? Avinash is here. Surya is here. Atulya is here. Srivastav is your first name. Shri Vatsav. Oh my God. Do you know out here in our region, Srivastav is the second name. But I just realized there is a difference. Shri Vastav is what out here in the central India is. Your name is Shri Vatsav. T is first, S is later. Great. Are you able to? So, very genuine. Before I proceed ahead, very true feedback without any manipulation or bias. How do you find my language? I mean, the way I've been speaking English. Are you able to connect to my thoughts? I mean, am I able to clearly convey to you the message when I speak? How much is your comfort on my language? Aksa, good enough. Thoughts are communicated, right? Because someone gave this feedback to me that when I speak English, I frame the sentences which are long enough. You know, adding one sentence to the another using conjunction, which is why someone told me that sometimes it becomes difficult to process. So I thought of asking it to you. But if it is working with you, that's absolutely brilliant. Avinash, cool, cool, cool. Do that puja from our side as well. We'll do the study from your side. All right. But make sure before the next live lecture you watch it recorded. It'll be anyways there on the YouTube, so you don't have to wait for it to get uploaded on the software. All right, people. So we all learned that, sir, when the examiner say growth rate in the question, do we blindly take that growth rate to be used in this formula? The answer is no. The clarity of concept is getting delivered. Everyone, please pay attention. We said, between 2 points, there is a growth rate in earnings, and there will also be some growth rate in the dividends. The growth rate of dividend may be different from the growth rate of earnings if the payout ratio is different. In our case, since the payout ratio of those 2 points was same, the growth in the earnings turned out to be the growth in dividend, but this cannot be your blind assumption. You will have to observe anywhere in the question if they specify the change in payout ratio. For example, the payout ratio changes from 50 to 60, and you have to now observe that even if the growth rate in the earnings is 10%, the growth rate in the dividend will be something else only, which cannot be forever assumed as 10%. Right? Further detailings of it we will learn later, but this was to give this clarity to you. For today, I will teach you one more particular thing, and then we move to the practical questions. Yes? So come on, super ultra fast everyone in the class. Sir, when it comes to, listen to me very carefully, when it comes to calculating the growth, one way is that examiner directly give me this growth number, life is sorted. Another way to calculate the growth is retention ratio into ROE. How many of you have already seen this formula at some point in your life? Come on. Either CA Inter or anywhere in your articleship by chance, or at CA final level in your regular batches. Come on. How many of you have already read this formula? Come on, everyone in the class, do tell me. Retention ratio into ROE tells me the growth. Komal is saying, sir, here to thank again to you. I don't know how come ICI ka paper can be solved in 1.5 hours, all because of the hard work you put in. Teaching the subject, you're phenomenal teaching. Thanks a lot again. So Komal, thank you so much. I feel happy when you write this because ultimately the batch has helped you out. Plus, I remember a few times at some point it happened that I could not respond to your doubts. So thank you for that understanding as well. Apologies. I don't mind doing that from a public platform, but I really feel happy. The exams really went well. Okay? Great. All the very best for the results. Come on, existing students, power people. I'm here to ask you, is the retention ratio into ROE, this particular formula, have you seen at any point before this? You have to respond, everyone. Come on. Komal, since you are here, can you please ask these people to respond as much as possible? You know what level of interaction do we need in the class, right? So tell me, all the live people who are sitting in there here in the class, please tell me, when had you last studied AFM by way of a batch? Had you ever attended a batch of AFM? Maybe regular, anyone? Atulya, Aksa, before we further proceed ahead, Surya, have you people attended any batch of AFM before this one particularly, or you are directly here in the final in this batch? Literally, I want to ask. Oh my god, Atulya, what are you saying? Everyone, this is the most important question. I think you must answer. My god, Atulya's first time learner exercise the directly here person. All right. And when are your people's attempts? Can you tell me when are your attempts? Sorry, huh? There is this disturbance. Avinash, you are my student only. So everyone in the class, Jan 26 is your attempt, or you have never done AFM before and you are here to rely on me for this. That's really, really great. Let me very clearly set some expectations again. You have put that trust on me. I would highly appreciate. 4 months before the exam, you are for the first time attending a batch which is very short duration with an expectation that you will be able to make it. I appreciate the level of trust you have put on me, because I know we can do it. I know we can put on those efforts. We can get that clarity. We can solve those questions which may make you clear up the exams. But one thing, let me very specifically tell you. Do you know, ideally, a first timer should not do this batch? Ideally. Because ideally, people in the market are doing which batches? A 300-hour batches, a 250-hour batches, right? What we are doing is relatively a very short duration batch. In terms of understanding the things, there will be almost no compromise. We will, however, solve limited question as compared to what we solved in a 250-hour batch, and it is quite obvious, right? It's all okay when we say it. Point is, despite solving such limited question, are we eligible to attend this batch for the very first time? The answer is yes, with a condition. Provided that you are able to make the extra efforts, provided that you are ready to work really hard at home every day. Because you have to realize that you are bypassing that entire effort of 250 hours and you have come to this batch of 70 hours. Even if I ask you to put additional 70 hours along with the batch, it is still worth it, because it is way less than those 200 to 250 hours. Yes? So very strict and clear message. Day one we made a commitment to ourselves that if we want, we can even score 80 plus in the class. But let me tell you, that's possible only if you are along with the class ready to put additional efforts in the at home, especially when you are a first timer. Yes, so please make sure, if you are watching a 3-hour lecture, you will have to put additional 3 hours at home. Doing what? Revising the concepts, very importantly, because you're not writing them down, you're just learning them. If you write in the class itself, they become firm. If you don't write, you have to revise it twice for them to become firm in your brains. Second, resolve the questions already done in the class in the notebook, and then also solve the questions not done in the class which were homework in the notebook by writing them down. If you do this much, I can tell you, even this small short duration batch can do the literally miracles. Are you all, everyone in the class, aligned to what I'm saying? This is not, I would ever say to anyone that put additional 3 hours. This is specifically for students who are doing this batch as a first timer. You have to take me seriously, otherwise don't expect from this batch. Because you have to realize what you are getting in this batch is already a facility. Otherwise, no one can teach you the entire AFM with this quality in just 75 hours. It is just the quality of notes we have, I'm able to deliver the concept to you so clearly, so specifically. Yes. So be prepared that you will have to make extra efforts. Okay? Because when I talk about Hindi language, You know, in a power batch, what percentage is first timer? Guess. Not more than 10% students doing power batch are first timers. If you are doing, I'm not demotivating that you can't do it. I'm saying you can 100% do it, provided you are able to make those extra efforts, that you come in the category of those 90% people that despite being first timers, with our extra efforts we have come to those 90% people's level of learning. Am I very strictly clear to every single student watching up this lecture? Come on. Public. So now let us proceed. Sir, we say, so I was under the impression you already knew this formula. So I was going to take you a level ahead, that you already knew this formula, but in this small formula you didn't know this particular thing. But now you don't have a benchmark to compare yourself with. Whatever I teach to you, even if it is more detailed than anywhere else, it will look normal to you. You say, okay, it is normal, this is what the logic is. No, when you go to the market, you realize the difference you make in this class. Any which ways, let's get back to the point. So let me now straight away tell you what this formula is: retention ratio into ROE. ROE, do you remember? Retention ratio, do you remember? What percentage of earning you retain is retention ratio? For example, 60%. And when you invest the balance of equity as per balance sheet, the capital equity as per balance sheet, how much return are you able to generate as per income statement? Suppose it is 10%. So 6% is the sustainable growth rate. 6% is the sustainable growth rate. Am I, people in the class, making sense? But this is the growth rate of dividends? No, it is the growth rate of my earnings. Which means this formula, the most important conceptual clarity is this formula give you the growth of earnings. After that, you will have to apply your brains. If the payout ratio is constant every year, then it is the same of dividend. If it is changing, then it is not the same growth rate for dividend. That is how you calculate growth rate. Now I'll take you all to the practical questions. Super ultra fast everyone in the class. Let us come to the practical questions. Have your calculators ready? By the end of today, mostly you will get the soft copy of the concepts notes, and by the end of tomorrow mostly you will get the soft copy of even the outscanner, the question bank, which will include the questions of even September 2025 attempt. Yes. However, those who watch this lecture after 6 months or anywhere, obviously when you get the soft copy, that will be further updated. Maybe after 6 months you might see Jan 26 exam paper also included in the notes, in the outscanner. Fine. So let us everyone in the class proceed. Sir, first question extremely easy. No point of doing this question in class. In fact, even one second, one second. Hold on for a minute. Because I need to update further question to it. I cannot specifically call it to be the Jan 26 book. However, before I update it, for now, let me name it so. Fine. Give me a minute, people. Fine. First question, extremely easy. It is so easy that you will have to solve it at home, and that too only on Calci. Sir, when I say solve it at home, whatever we mark red, you have to solve it at home. Whatever we mark green, you have to solve it in the class. And whatever I put a cross to, you don't have to solve it for the exam. Yes? So let us proceed. Sir, question number 2 is a good one, easy question. Let's very immediately solve it in the class. Be 100% attentive, have your calculators ready, we are starting. Sir, a company has a book value per share of 137.8 rupees. Its return on equity is 15%. So let's figure out what have we been given. We have been given the book value per share. We have been given the return on equity. The company follows the policy of retaining 60% of the earnings. Retention rate of the company has been given. Opportunity cost of capital, which means the cost of capital, which is cost of equity, which is 18%. What is the price of share today? Looking at the data, they are asking you to calculate the price. First of all, you all help me to identify which particular model. Zero growth model or constant growth model? I mean to say zero growth model or constant dividend model. Sir, have they anywhere talked about the growth of the dividend? Not specifically. Can anyone in the class identify if the growth can be somehow calculated? Come on. All the life people, keep your brains ready, keep your calculators ready, think and respond. Can you find out if the growth has been given or not? And if not given, can it be calculated or not? Come on, apply your brains. Come on. Sir, what do we say? Can we all, everyone in the class, say that, sir, if I have been given the ROE and if I have been given the retention rate, so retention rate multiplied by ROE, sir, will give me the sustainable growth rate of my earnings, which means if the growth can be calculated, I'll have to apply the Gordon's formula, which is D1 divided by K minus G, D1 divided by K minus G. So I have the KE ready with me, which is 18%. I have the growth rate ready with me, which is 15% of 60%, which is 9%. But I don't have the amount of dividend ready with me. I'm trying to give you 30 seconds to not get the answer, but at least try to think, everyone in the class, how do you calculate D1? People, please do try. Think, people, think. If you think, you evolve. And that's what I want you all to do in the class. Sir, I need dividend. What is given to me is the book value. Using book value, how do I calculate dividend? Sir, figure out the data given in the question. Try to apply something out of it. Sir, ROE has been given. Sir, what was the interpretation of ROE? Of the book value, what is my EPS in percentage terms? How much do I earn in percentage term? So can I say, sir, RO is nothing but EPS divided by book value per share? Whenever examiner asks you a tricky question, there is a very simple way to come out of it. Whatever has been given by the examiner, try to put the formula of it. For example, ROE given, formula is ROE is equal to EPS divided by book value per share. Now I know ROE is 15%, that is equal to EPS divided by 137.8. So can I say 15% of 137.8, everyone in the class, is my EPS, and whatever is the EPS, 40% of it is the dividend, and hence I get my D1. So super ultra fast, everyone in the class, have your calcs ready. Sir, 137.8 multiplied by 15% multiplied by 40% is 8.268, being the amount of D1, divided by K being 18%, G being 9%. So divide by 0.09 gives me 91.87 as the answer to this particular question. People, do solve it. After you have done, please tell me if you have any doubts. Tell me in the chat box. If no doubts, please tell me if you are settled or not. Come on. Waiting for you to calculate. Build your comfort and then come to the next question. Could you understand what did we do? Everyone, what did we do? Sir, 137.8 multiplied by 15% gave me EPS. Of that amount of EPS, if retention ratio is 60%, retain earning is 60%, then payout ratio is 40%. Yes. So now I know 137.8 multiplied by 15% is EPS, multiplied by 40% is my dividend. That is what I want. And 8.268 is the amount of dividend. Give me a minute, let me have water, then we proceed ahead. Come on, all the live people, please respond. When you respond, I get to understand at what level are you able to connect the concepts. Super ultra fast, we can't be waiting this much. If the answer is no, happily say no. If the answer is yes, happily say yes, but you have to respond. Otherwise, what is the point of sitting live here when the lecture cannot run as per your understanding, as per your convenience? So just two responses so far from Aksa and Surya. All other live people in the class, please respond. Srivastav, is it working? Atulya, Sarvendra, is it working? Yes. So let us people proceed. Question number 3 is a similar nature easy question. You have to do it in homework, marking it red. Question number 4, similar nature easy question, super ultra fast, we will do in the class. Everyone, come on. Following are the details of company X Limited and Y Limited. There are two companies, X Limited, Y Limited. If you talk about their dividend per share, it is 4 and 4. Sir, examiner is silent if the dividend is D0 or D1. I said if it is silent, assume D1. Similarly, that's what you did in the previous question. What have you assumed? The dividend so calculated has been assumed as D1. Similarly, the dividend here will also be assumed D1. The growth rate is 10%. The beta is 0.9 and 1.2. The market price per share is 150 and 70. Risk-free rate 7%, RM 14%. Calculate the price of share for both the company. Actually, the price is given in the market. What they are asking is the intrinsic value, but they are sometimes vaguely saying intrinsic value to be the price. So let's proceed. Let's proceed, everyone in the class. If I have the beta, if I have the RF, if I have RM, can we please everyone in the class calculate the cost of equity? Yes, let's think for company X. Sir, RF is 7% plus beta is 0.9 into RM minus RF is again 14 minus 7. So 7 plus 0.9 into 14 minus 7. So 14 minus 7 into 0.9 plus 7 is equal to 13.3%. Is equal to 13.3%. This is what, sir, my cost of equity. If I have the dividend, if I have growth rate, and if I have the cost of equity, can I apply Gordon's model to find the value of the share? Answer is correct. It is 4 divided by 13.3 minus 10, which is divided by 0.033, gives me 121.21 being the price of the share. Sir, despite two companies, dividend being same, growth being same, will the value of the two shares be same? The answer is no. Because the beta is different, due to which KE will be different, due to which value will be different. For the second share, if you calculate the value, it turns out to be 74.04. We have not done it in the class, we have done for one security in the class entirely. Now the examiner asks you comment on the valuation and the course of action. According to me, the value should be 121. The value in the market is 150. What I'll say? I'll say that the share in the market is overvalued. Price in the market is more than its intrinsic value, and since it is overvalued, my action will be to sell this particular share. Are you please able to connect to question number 4 that we have just solved in the class being asked in the exam of November 2021? People, for this one again, kindly respond. At every step in every question, I will stop to ask you people to validate if you got this or not. Simple. Srivastav, yes. Other live and recorded people in the class, what do you all say? Question number 5th, similar nature easy question. We gonna solve this question, or sorry, it's homework. You gonna solve this question only on the calculator. The only point is that I have to make you aware that, sir, when they say equity capitalization rate, it is an alternative word for KE. When they say return on investment, it is an alternative word for ROE. Now rest of the thing is easy. Question number 5th is easy. Question number 6, we do it in the class. Come on. Sixth question in the class. Shares of Voyage Limited are being quoted at a price of 8 times. Sir, what is the word P ratio? At a P ratio of 8 times. Sir, P ratio meant EPS divided by MPS. How many times the price of a particular share in the market is relative to its earnings? Sir, it is 8 times in the market. The company retains 5 rupee per share, which is 50% of its EPS. If retention ratio, which is 50% is equal to 5, then my EPS, which is 100%, is equal to how much? 10. Do you agree to what I'm saying? Retention ratio, if 50% is equal to 5 rupee of retained earning, then EPS being 100% is equal to 10 rupee. So if my EPS is 10, if my P ratio is 8, can I say the MPS to be 80, everyone in the class? Let's figure out what is examiner asking us to calculate. Determine cost of equity if the growth rate is 15%. Please tell me, determine cost of equity. The first approach to calculate KE is CAPM. But do you see the data of RMRF etc.? No. The second approach was Gordon's model, which is D1 divided by P0 plus G. Do you have the number of dividend ready with you? Sir, the number of dividend is ready with me. Because retained earning of 5 rupees equal to 50% of my EPS, then rest of the 50% will also be equal to 5 rupee, which is my dividend. So dividend is 5, price of 80 plus growth of 0.15. 5 divided by 80 plus 0.15 is 21.25 as my cost of equity calculated for part A. Yes. Similarly, sir, calculate the indicative market price with same cost of capital and anticipated growth rate is 16%. Sir, you have to calculate the market price again. Indicative market price means that intrinsic value only. Calculate indicative market price, same cost of capital, 21.25% being the cost of capital, growth rate being 6%, which means now when I have the cost of capital and growth rate, I have to apply the Gordon's model. So if the dividend of first year is 5 divided by 0.2125 minus 0.16, give me the value of share. Come on. 0.2125 minus 0.16. The denominator is 0.0525. Denominator is 0.0525. Sir, how do we entirely solve it on the calculator? Really easy. 0.0525 is there on my computer screen, calculator screen in the denominator. If I press divide equal to, it'll be like I have solved 1 divided by 0.0525. It's like solving 1 divided by 0.525. On my calci right now it is 19.476. So I know that first I solve the denominator, then I press divide equal to, so basically I have solved this part, I have arrived to this number, multiplied by 5 in the numerator will give me the value, which is 95.2324 on a rounded off basis. C part of this question is really easy, that you will have to do at your own in the class right now. Question number 6 then gets done. Do solve question number 6 part 3 and give me a minute in the meantime. Everyone waiting? Could you solve part C of sixth question, an easy one at your own? Come on, please tell me fast. Is that all? People in the class, come on. Question number sixth gets done. All right. So we all now move to question number seven. Okay. Question number seven, an easy question. You will have to do in your notebook at home. Question number seven, homework. Question number eight. Uh, 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 we do in the class. Question number nine, not to be done. Question number eight. Ultra fast, everyone in the class. When I write only on Kelsey in front of a question, what does it mean? That even at home, people in the class, even at home, you don't have to solve this question in the notebook, only the Kelsey solution will be sufficient. All right, everyone? Yes? So let us proceed. X Limited just declared a dividend of rupee 14 per share. Mr. B is planning to purchase the share of X Limited, anticipating the growth rate from 8 to 9. Just declared dividend, which means I have do 0. Growth rate that I am expecting in future is 9%. Sir, market price he want the share. Market price of share he want is 360. After 3 years, he expect the market price to be 360. What is the maximum amount Mr. B should pay if he require 13% return? So common sense is really simple. The amount that you pay today is the present value of future cash flows. This time, do you realize I have a question with me having definite number of years as my holding period, just 3 years. I just declared a dividend of 14 rupee. I can estimate the dividend of next 3 years. 1, 2 and 3. And I can also estimate the selling price of rupees 360 to be received at the end of third year. Correct? Let me, people in the class, check if I have drawn it on the timeline for the regular batch students. Not actually, because it was an easy one. These notes which you look at are the notes of regular batch students. Yes. So anyways, let us proceed. Sir, let's first of all try to calculate the amount of dividend on the Calci. Sir, my growth is 9% per annum for the next 3 years. Examiner has given to me the future value factor for year 1, year 2, year 3. Which means if you want to apply 9% growth rate for 1 year, 2 year, and 3 year. Directly multiply your number with these factors, automatically you'll get your future values. So sir, at the rate of 9%, it is 1.090 multiplied by 14 gives me 15.26. 1.188 multiplied by 14 gives me 16.63 as the amount of dividend. Then 9 multiplied by 1.295 gives me 14 multiplied by 1.295 gives me 18.13. These are the dividends for next 3 years. At the end of third year, I will also receive a selling price of 360. So think about my future cash flow. 1, 2, 3. 15.26, 16.63 and 18.13 plus 360, which is 378.13. All these future cash flows are to be discounted at the rate of 13%. Rest. Why 13%? Because my required rate of return is 13%. At the rate of 13%, I can see the present value factor 0.885, 0.783, 0.693. So let us now solve it on the calculator. Sir, 15.26 is the first year's cash flow multiplied with the factor of 0.85885 m plus, right? So 15.26 multiplied by 0.885 m plus, one second, m plus. Then 16.63 is being the second year cash flow multiplied by 0.783 m plus. Then 378.13 multiplied by 0.693 m plus. Memory recollect give me 288.57048, basically 288.57 being the maximum price. Everyone, could you connect? The next one, everyone, is find the maximum price willing to pay if he is of the opinion that 9% growth be maintained indefinitely, which means this time for indefinite number of years I'm planning to hold the share. I will have to enter into dividend discount model, indefinite period. Everyone, I am planning to hold the share indefinitely with 13% required rate of return. Sir, 14% is my people D0. So that into 1 plus G will give me D1 divided by KE of 13% minus the growth rate of 9% will be the value of the share. Can anyone in the class give me the value of the share in this part B of the question as per what I have just explained now? All the live people, all the recorded people, do try to solve it. You have D0 with you. You have the forever growth rate of 9% with you. Now all you have to do is to do the calculator and give me the answer. People waiting for your responses. Just a second. People says it is 381.5. Others in the class, please confirm and validate if the answer is 381.5 or not. The answer, everyone in the class, is absolutely correct, 381.5. First I had D0, so I have taken D1, which is 15.26 divided by K minus G. An easy thing, answer is 381.5. Other live and recorded people in the class, can I expect you are able to solve it? Come on. Now the next part of the question is the price of the share at the end of 3 years if 9% growth rate is achieved. Oh my god, what they have asked is really a brilliant one this time. They are asking you to calculate the value of the share not today, rather at the end of third year. Please imagine it on the timeline, people. At the end of third year, if you have to calculate the value, this is where you stand now. So value at the end of third year will be dividend of next year, which is D4 divided by K minus G. Do you realize? Sir, do I have D3 with me? Yes, sir, 18.13 I calculated. So can I do simply 18.13, which is my D3, into 1.09, growth rate will make it D4, divided by 13% of K minus growth rate of 9%, giving me the price at the end of third year. Sir, 18.13 into 1.09 divided by 0.04 is 494.04, being the price of the share at the end of third year. Yes, people. My ask is, how much out of 10 are you people please settled with question number 10 that we have just solved in the class? Come on. Every live and recorded student need to respond to it. How much out of 10 are you people please settled? Come on. If you want to temporary refer to this out scanner, I will suggest you one thing. In the description of this YouTube video, let me check, because I remember I had in the description of this YouTube video, I had people in the class uploaded the question bank. A sample question bank was being uploaded. Fine, give me a minute. Sample out scanner was being uploaded. For now, you can download it and refer to it if you want. Aksa, if you have any doubt, you may please ask other live people in the class. Please respond. How much out of 10 are you people settled with this question? So question number 8 gets done. Ninth question a bit tricky, but less probable question in the exam. We are skipping. Question number 10. Again a rare nature of question, not to be done from exam point of view. 11th question is really a brilliant question that we will have to solve in the class. Come on. 11th question, a really good one. Let's proceed to solve it in the class. Right now, in December 2011, AB company share was sold for rupee 146 per share. Price of the company's share has been given. Long-term earnings growth rate is 7.5%. Please observe they have given to you the growth rate, but not of the they have given to you the growth rate, but not of the dividend, but of earnings. AB company is expected to pay dividend of 3.36 per share. Sir, do you realize one thing? Expected dividend has been given, price has been given, growth rate has been given. They are saying what rate of return can an investor expect? What is the rate of return that an investor can expect, assuming that dividend are expected to grow along with the earning at the rate of 7.5% in perpetuity? This time they say that the growth of dividend is same as the growth of earnings. So I have G with me, the growth of dividend. I have P0 with me being the price of the share. I have D1 with me being 3.36. What I have to calculate is the KE. The rate of return investor can expect, which is investor can require, simply KE. How many of you think that given the data you can calculate KE? Come on. People. Come on, come on, come on. If you participate, you think, you learn. You may find it struggling now, but ultimately you learn. Please tell me. Using which formula we can calculate KE? Sir, first option is CAPM. We can't apply it because RMRF is not there. Second preference was Gordon's model, which is D1 divided by P0 plus G. Let us apply 3.36 divided by 146 plus 0.075 is 9.82%. Why am I getting 9.82? 1 second. 3.36. 9.80% being the KE, being the KE, we can do it. Sir, this is the answer to part 1 of this question. Second part is actually more importantly brilliant. I'll need your attention, I'll need your focus on this particular part. Mark it as part B. And now let us solve it. It is expected that AB company will earn about 10% on book equity and shall retain 60% of the earnings. Company's ROE is 10%, company's retention rate is 60%. Given the two data, can I say company's growth rate will be 6%? What was the growth rate now of earning? 7.5. What has given the growth rate? What has become the growth rate now for earning? 6%. Okay. In this case, whether there would be any change in the growth rate, we say yes, obviously there will be a change in the growth rate. It will become 6%. Fine. Most importantly, will there be any change in the cost of equity? The answer is again yes, because cost of equity is D1 divided by P0 plus G. Earlier, I was doing D1 to be 3.36 divided by price of 146 plus the growth of 0.075. Now as the growth rate will change from 7.5 to 6%, automatically my KE will also change. This much are you clear? Because the main thing I have not even started teaching to you now. I'm yet to teach to you the main thing I want to explain. This much are you clear, people? Please respond, tell me. From 7.5% to 6%, the growth rate, everyone in the class has changed. Please tell me. What do you say? So I am aligned. If you are aligned to me that the growth rate has changed, most importantly, let me ask you a question. Will my dividend change due to change in the growth rate, due to change in the payout ratio? Because the payout ratio has become 60%. Due to change in payout, will the amount of dividend change? Yes. Whatever earnings companies is expected to have at the end of first year, now company will distribute 60% of it. But sir, how much was the distribution earlier? You can imagine it very easily. Sir, earlier company's growth rate was 7.5. I know that growth is equal to retention ratio multiplied by ROE. The growth previously was 7.5%. The ROE previously, everyone in the class, was 10%. Because ROE doesn't change. I can change the retention rate, I can change the dividend payout ratio because that is in my hand. ROE is not in the hands of company. They generally remain consistent in short term. So I will say that my growth is 7.5%, my ROE is 10%. So what was my retention rate? If you back calculate, retention rate will turn out to be 75%. The retention ratio, which was 75%, if now becomes 60%, won't the dividend change? Obviously, it will change, sir. Do you realize, sir, change in growth is fine, but the dividend is also needed to be changed. Requesting your responses, people. Are you able to connect to my thoughts? I'm yet to make you people calculate what is the exact dividend that will come here. But first of all, you should realize that, okay, the dividend will change. Yes or no? Come on. So let me show you all. Let me show you all a diagram, a timeline that I have drawn for regular batch students. This is here it is. This is here it is. Sir, at present, I am estimating my D1 to be 3.36, which was based on the retention ratio of 75%. Which means I might have estimated my EPS to be how much? Sir, 3.36 being the dividend amount, 25% being the payout ratio. So divided by 25% give me the earning EPS existing estimate of even to be 13.34. Now I know that, sir, this dividend was based on 25% payout ratio or 75% retention ratio, first thing. And it was based on the earning growth rate of 7.5%. Now, as per my changed policy, two things will change. The growth rate will become 6%. So I will have the newer earning. And of that newer earning, I will distribute 40%. So I will have the newer dividends. It is not just the growth rate which has changed. It is also the retention ratio which has changed, which will not only affect my dividends, but will also affect my earnings, because retention ratio into ROE is not the formula of growth of dividend, it is the formula of growth of earnings. So I will have to first of all apply this formula of 7.5 and 6%, apply this growth rate of 7.56%. This is my previous estimate, this is my new estimate of growth. So I will have to apply these growth estimates to the earning first of all, not directly on the dividend, and then calculate the dividends. Yes. Sir, let us calculate it. I was estimating even. At present, I was estimating even of 3.36, which is based on 25% payout ratio. So what is my present estimate of even? Sir, 13.44. This estimate was based on 7.5% of growth, whereas the growth I will have is 6% now. So I will have to divide it by 1.075 to find out how much would have been the E0. The E0 would have been 12.5%. I have to multiply it by 1.06 to say that revised E1. From the older estimate of even, I will now come to the newer estimate of even, which will be 13.25, of which everyone in the class, if we distribute 40%, it turns out to be 5.3 rupees as my revised D1. Are you all, please, everyone in the class, able to connect what is going on? Come on, tell me. Come on, people in the class, please tell me. Yes. So I have now the revised dividend of 5.3, revised growth rate of 6%, revised price of 146, and now I can say accordingly, sir, how much is my KE? 5.3 divided by 146 multi plus 0.06 giving me 9.63% as my KE. Sir, this is specifically a question which has this treatment. Which treatment? Of eliminating the older growth rate from the EPS and giving the effect of newer growth rate to the EPS, which means from older even I have to first calculate E0, and using that E0 I'll have to then calculate revised E1, and using revised E1 I will have to calculate revised D1. That is how the presentation is. Is this timeline driven presentation making sense to you people? Could you understand this question on the timeline? So if you realize what is my start point, this is my start point. And what is my end point? This is everyone in the class, my end point of the story. This is how it has gone. Set are we? Sorted are we? So that completes everyone in the class question number 11. And now is the turn for question number 12. Sir, can be ignored. Question number 12. Or maybe you can solve it on the calci. Let's make it homework. This particular easy question you will have to solve at your own on the calculator. Question number 13 is something we will do in the class right now. People, are you all there? What do you say? Shall we proceed? Everyone. One second, huh? Give me a minute. Give me a minute, please. All right. Let's proceed to solve question number 13. Everyone in the class right now. We are going ahead. Shall we? Sir, following financial data is available for PQR Limited for the year 2008. For a particular year, 2008 financial data has been given. Sir, 8% debenture, 10% bond company has, equity share company has, reserves and surplus company has. Which means when they say equity share, there's this small mistake in the question. They meant equity share capital. Because this is amount, this is amount, this is also amount, this is not number of shares, right? And company has reserve surplus. Company has total assets of 600 rupee. What is the total of this part in the liability side? Sir, 125 plus 50 plus 100 plus 300. So 575 the total is turning out to be, whereas the total asset is 600. So maybe 25 would be the current liabilities. We don't know. Fine. Asset turnover ratio is 1.1. How many of you know what asset turnover ratio is? How many of you can tell me what the asset turnover ratio is? And also give me a चलिए, so what do you say? Come on, all the live people, all the recorded people, what do you say? Sir, asset turnover ratio means how much is the sales relative to the average assets that my company has. So if I have the total assets of the company and if I have the asset turnover ratio, can I calculate the sales of the company? Maybe yes. Then they ask you how much is the effective interest rate. Sir, what do you mean by effective interest rate? You can relate to this concept to the one that you've already done in FR. Effective interest rate means the rate of interest that actually go to the income statement. From the perspective of this question, can I say effective interest rate is the one? Effective interest rate is the one that people goes to the income statement as a percentage of my total amount of debt. 8% of it will go to the income statement. Effective tax rate is again as a percentage of PBT. What percentage of PBT is my tax amount? Sir, operating margin is obviously EBIT margin. Sir, dividend payout ratio is 16.7%. Current market price is 14. Required rate of return is 15. You are required to draw the income statement. Oh my God. Which means right from revenue till the end, you have to draw the entire income statement. Have we been given sufficient details? Sir, using asset turnover ratio and total asset, we can find out sales. Of that sales, 10% is EBIT minus 8% being the effective interest rate we can calculate, we'll get PBT, of which 40% is tax, we will get PAT, of which 16.6% is the dividend distribution, will get retained earnings. That's how you can draw the entire income statement. So very immediately, sir, turnover ratio is equal to asset turnover is equal to sales divided by assets. If assets are 600, sales I am yet to calculate, ratio is 1.1, sales turns out to be 1.1 into 600 is equal to 660. Where is it? Sales of 660. Of which 10% is EBIT, which means 90% is cost. 660 multiplied by 90% is 594 being the cost. So sales is rest of it, which is 10%, which is 66. Yes. Now from this amount of sales, EBIT of 66, I deduct interest. So 175 being the total amount of debt multiplied by the effective rate of interest of 8% is 14 rupee of interest to be deducted. So 66 minus 14 gives me 52 rupees of PBT, of which they say tax rate effectively is 40%. So 52 minus 40% give me 20. 52 into 40% is 20.8 being the tax amount, 31.2 being the PAT, of which 16.67% as 52 5.20 is the amount of dividend. So retained earning is 26. I have drawn the income statement based on whatever data was available. Yes. Next, what I do, sir, I have to calculate sustainable growth rate of earnings. So anyways, the formula we have is the sustainable growth rate of earnings only. Sir, I have to do retention ratio into ROE. If 16.67% is the payout ratio, then retention ratio will be how much? Everyone in the class? Sir, 100 minus 16.67% is 83.33% being the retention ratio multiplied by ROE. Let's think about ROE calculation. Give me your answer in true or false. ROE means in the denominator how much you invest, in the numerator how much you earn. So what I invest in the denominator is the market price and what I earn in the numerator is the EPS. So EPS divided by market price per share is ROE. Agreement, disagreement. People in the class, everyone is supposed to respond. Come on. Come on, come on, come on. Everyone is supposed to respond. The answer is absolutely incorrect. Because, sir, ROE is a measure, ROE is a ratio based completely on the financial statements. ROE has nothing to do with the market price. So, in the denominator comes the investment, but as per my balance sheet. In the numerator comes the earnings as per my income statement. Everyone in the class, are you able to connect? So, how much is my PAT? 31.2. How much is the amount of investment of equity? 400. So how much is 31.2 divided by 400? It is 7.8% of ROE. So 83.33% people is the retention ratio multiplied by 7.8% of ROE gives me 6.5% of my sustainable growth rate, being the second thing I had to calculate. Third thing examiner is asking is the fair price of company's share using dividend discount model. So far what you have learnt is that in the absence of information assume the dividend to be given, which institute does in most of the question except this particular question. In this particular question, institute assumed the dividend to be D0, and please don't worry about such ambiguities. We can try to remember them. If you are easily able to remember it, it's good. If you are not able to, don't worry about it, forget it. It is a matter of luck, not you are facing, every single student across India is facing. You can try to remember that, sir, in this particular question where institute asks you to prepare the income statement, the only question in the entire chapter. The only question in the entire chapter where income statement is needed to be prepared, in that particular question, dividend calculated is assumed to be D0, not D1. So anyways, I have the total amount of dividend being 5.2 lakhs divided by the number of share. Sir, 100 lakh share capital, 10 rupee face value of each share. So give me 10 lakhs being the number of share. Sir, accordingly 5.2 lakhs, 5.2 lakhs divided by 10 lakhs give me 0.52 as the dividend per share. Plus the growth rate of 6.5% I have calculated divided by KE of 15% minus the growth rate again of 6.5% will give me the fair price of the share using dividend discount model. So what do I do? 0.52 into 1.065 divided by 15 minus 0.065 means divided by 0.085 gives me 6.515, 6.52 actually as the value of share. Since price in the market is 14, in part D of this question, we have to give your opinion. We will say that the share is overvalued. We should sell the share. We should not invest in this share because it is overvalued. Yes, question was really easy. The point of learnings were understanding how do you make use of effective interest rate. Secondly, understanding it was equity share capital, which is their ambiguity, not your understanding. Third and most important, the concept of dividend, that it is to be assumed D0. Rest of it is logical and a good question. Boss. Question number 13, what is the status of your learning? Please tell me. Question number 13, the status of your learning. Please tell me. Question 14. Let's not discuss this ambiguous question here. Not that the question is not asked recently, it was being asked in the attempt of November 20. But given its rare nature, it doesn't make sense to cover this question in the class, which is why we are eliminating it. So Power Batch is not about completing everything. Power Batch is about identifying the things which are more, probable to be asked in the exam. So in lesser efforts, we try to cover those things which has a higher probability of being asked. So basically we try to do 80% of the things which has 90-95% chances of being asked. So with 80% of the marks, we try to cover 95%. With 80% of the efforts, we try to cover things which belong to 90-95% marks. Is the approach clear? I'm trying to be transparent. I don't want to build an expectation that you are doing 100%, but yeah, we are doing a smarter work. And by doing 90% of things at home, we just have to apply 80% efforts. So doing those 80% things in a better way will bring you more marks than covering 100% things in a less better way. Correct? So 14th question not needed to be done. 15th question not needed to be done. 16th question we will do only after we have learned the next concept, but for that we'll first take a break. It is 10:40 right now. We meet back at 10:55. After this 15-minute break, we learn the concepts ahead of very interesting concept, and based on that we'll solve further questions. Is that all the live people in the class? Please fine. Come on, tell me. Come on. Are we all set? Yes? We all proceed to take a break. So please be back, everyone in the class, by 10:55. See you all? Bye, people. चलिए बॉस, are you all there? Back people, please. Everyone. Shall we proceed ahead? So what we should now be learning? Fine. There. So what we should now be learning, the next concept, everyone, which is the variable growth model. The variable growth model. I said you have to ultimately do present value of future cash flows. Everyone in the class, are you all there? Aligned to me? Let's get started with our discussion. We are learning the next model called as variable growth model. So we said the value of share is the present value of future dividend. Fine. Depending upon the pattern of dividend, we decide the model to be applied. In the first case, the dividend was constant. There was no change, no growth in the dividends. You apply this model. If the dividends show a constant growth rate till infinity, you apply this model. However, if the dividends show a variable growth rate, then you apply this model. Sir, what do you mean by a variable growth rate? Sir, let me give you an example. For example, examiners say that the dividend just distributed was 100. The dividends are expected to grow for the next few years like this. First year will grow by 10%, second year will grow by 15%, then by 9%, then by 8%, and then from year 5 and onwards, it will grow by 7%. Do you realize that the growth rate of dividends is not constant till infinity? But yes, till a particular point, till a particular point, it is growing at a variable growth rate. But yeah, after a point, it has become constant. Till a particular point, it's growing at a variable rate, but after it has become constant. In such situation where after a point the dividend growth become constant, you can apply variable growth model. Yes. Sir, how do we apply? It is really simple. Whenever you face this question where dividends are growing variably, you should try to draw it on the timeline. It might take your extra 10 seconds, extra 30 seconds, but it will be worth drawing because it will eliminate all the confusions. Right? I'm trying to teach you with 100% conceptual clarity. Please pay attention. Sir, I see that the dividend at 0 point is 100. Then for first year, the growth is 10%, it become 110. Then the growth is 15%, it become 126.5. Then by 9% growth at the end of third year, dividend become 19. With 8% growth rate, dividend become 148.92. Now, till the end of fourth year, with 8% of growth rate, my dividend has become 148.92. For fifth year, growth is 7%. So fifth year dividend is this. For sixth year and onwards, growth continue to remain 7% and on. This is just presenting the question on the timeline. My question to you all is, where can you apply Gordon's formula? In which situation do you apply the Gordon's formula? Sir, only when the dividends are growing at a constant rate forever, I can apply the Gordon's formula. Correct? Only when the dividends are growing at a constant rate forever, I can apply the Gordon's formula. That is what I'm saying. At 0 point when you stand, do you see a constant growth in the dividend forever? No. Which means, can you apply Gordon's here? No, sir, we cannot. Then can you all, everyone in the class, please pay attention. Can you all please identify At the end of which year, if I stand and look at the future, I'll have a constant growth rate forever of 7%. Sir, it is first year end or second year end or third year end or 4 or 5. At the end of which year, if I stand and look at the future, I will look at the constantly growing dividends forever. People, please identify on the timeline. Sir, at the end of 4 year, if I stand, the growth rate forever is going to be 7% only. Which means, do you agree? If I stand here, I can think of applying the Gordon's formula because the growth rate has become constant. Everyone, first step after drawing the thing on the timeline is to imagine from which point onwards the growth rate is forever constant. That particular point is where you stand and apply the Gordon's formula. At the end of 4th year, if I apply Gordon formula and calculate a value, please imagine what is this value giving me. It's not only about the formula, it is about understanding what you're doing. The value that you calculate here is called as terminal value. Since you are calculating at the end of 4 year, it is TV4. What does this value do? It discounts all the future cash flows. What does the formula of Gordon's do? It discounts all the future cash flows, meaning to say, right from the dividend of 5th year. When I stand at 4 year, do you agree the first cash flow which gets discounted will be D5? Array boss, what I want to tell you is that when you stand at 0 point, the first dividend which gets discounted is D1. So similarly, when I stand at 4th year, the first dividend that gets discounted is D5. But yeah, all the dividends from year 5 to infinity, everything gets discounted through this formula of d5 divided by k minus g. From d5 to d infinity, everything has been discounted to year 4 using this formula. The value so arrived is called as TV4. People, on this particular part that I was trying to explain, I'm seeking your validation. Could you understand the logic? Come on. Even if the dividends are variable glowing, at a point I feel they have become constant, and on that point I calculate terminal value which discounts all the future cash flows to that particular point. Now I know that ultimately I need the value of share as present value of all future cash flows. Can I say from year 5 to infinity everything has been discounted and those cash flows are lying at the end of 4th year under this value, in this value of TV4? Yes, sir. Now, if I have to bring the cash flows to year 0, can I say cash flow 1, 2, 3, 4 and even 1, 2, 3 and even 4? These 4 dividends are not yet discounted in TV4. Which is the first cash flow TV4 discounts? Sir, 5th year's dividend is what it discounts. So which means, can I say 1, 2, 3 and even 4th year's dividend is not yet discounted? And at the end of 4th year, I have TV4, which has present value of D5 to D infinity. So can I manually discount the 4 dividends and the terminal value of 4th year and bring them to 0 point and calculate the value of share through this model in 2 steps? First, calculating TV, bringing everything from 5 to infinity to 4, and then manually discounting the cash flows lying from 1 to 4. Hence, you arrive at the value of the share. People in the class, this was variable growth model. Could I conclude it for you that in that case, present value of dividend till n point, the point where I calculate the terminal value, and the terminal value of that particular year will be the value of share. Please respond, how much out of 10 are you conceptually clear? Public, people. How much out of 10 are you people conceptually clear? What do you all say? Come on. So now what I say? Conceptually, are you clear? So now what I say, people in the class, I'll take you to a practical question. This question is a really easy question. Let's not enter into it. Let's enter into the next question. The next question actually is homework. I'll take you to further next question, which is question number 18. Come on, people. XYZ Limited paid a dividend of rupee 2 for current year. Paid a dividend, it is D0. The dividend are expected to grow at the rate of 40% for the next 5 years. Sir, let me figure out if I have a timeline already drawn for this particular question number 18. Not really. It is drawn for question number 19, but 18 I'll draw it myself right now for you. Come on. So they say for the next 5 year growth rate will be 40%. So it is at the end of 5 year. Every year 1, 2, 3, 4, 5. It is, sir, 40% of growth rate of my dividends every year. Sir, directly the growth rate of dividend is given. Please observe, it is not the growth rate of earnings which is given. Yes, sir, fine. And at 15% thereafter, after it, the growth rate will be how much every year? 15% every year. Fine. Sir, the return on 182-day treasury bill is 11% per annum. Sir, the treasury bill, which means the government security, which means the risk-free rate of return is 11% per annum, market rate of return is 18%, and this particular line in the pink color, the red bracket, you ignore, because you understand this line only after you are done with portfolio management. It is a very easy thing, but you will learn only in portfolio management. For now, let's say we are given the beta to be 1.25. So we have been given beta, we have been given RM, we have been given RF. Sir, first we have to calculate the KE. Sir, RM 18, RF 11. So 18 minus 11 multiplied by the beta of 1.25 plus 11. 18 minus 11 into 1.25 plus 11 is 19.75 being the 19.75 being the calculation of KE. Done. Yes, sir, sorted. Now I will have to identify. I know that when I stand here, I see that the growth rate till future is not constant. For few years it is 40%, for rest of the year it is 15%. So at 0 point when I stand, I cannot directly apply Gordon's. What do I do now? Sir, you stand at the end of 5th year and look at the future. Is the growth rate constant forever? Answer is yes. So you calculate TV5 here by applying Gordon's. To be able to apply TV5, you need D6 divided by K minus G. Agreed. Sir, and you anyways need the dividend of next 5 years. So let's do one thing. First of all, let me calculate the dividend of next 5 years. 1, 2, 3, 4, 5. Dividend just paid was 2. So 2 plus 40% for the next 5 years. Let us do. Sir, 2 plus 40% is 2.8. Plus 40% is 3.92. Plus 40% is 5.488. On the calci, it is 5.488. In the notebook, I'll write it as 5.49 plus 40% is 7.68 and plus 40% is 10.76. Everyone in the class, these are the dividends of next 5 years. Sir, there is a calci shortcut about it. I'll very immediately explain to you. On the calci, type 1.4. 1.4 is basically 1 plus 40%. 1.4 multiplied by 2 is equal to, first thing you have to take is 1.4 compulsorily multiplied by your number, which is 2. When you press equal to, it is 2.8, again equal to 3.92, again equal to 5.488, again equal to 7.68, again equal to 10.756, which is 10.76. The shortcut to calculate the dividends. Sir, for the next 5 years, the dividend is 5. At the end of 5th year, again my TV is at the end of 5th year. So please take 5 here. Don't take it 6. So it will be like 1, 2, 3, 4, 5 and 5. 1 5 for dividend, another 5 for terminal value. Terminal value at the end of 5th year will be based on the dividend of 6th year. So dividend of 5th year into 1 plus growth will be the dividend of 6th year. Divided by 19.75 being KE minus the forever growth rate of 15% will give me TV5. So let's calculate, everyone. 10.76 into 1.0, sorry, into 1.15 divided by 0.0475 is equal to 420, one second, 10.76 into 1.15 divided by 0.0475. It is 260.51. On my calculator, it is 260.51. Please rectify if needed. Right, sir, these are the cash flows from year 1 to year 5, which are to be discounted now manually at the rate of 17.75%, 1, 2, 3, 4, 5. 5 years dividend and terminal value at the end of 5th year, all of them to be brought down to 0 point. I have to multiply them with present value factors, where the factor of 5th dividend and 5th year's terminal value will be same. When you discount them, the answer which turns out to be 122.13. I've not done the calculator discounting but explained to you everything which is needed. Could I please solve question number 18 with you all in the class, and are you understanding how do you do a question of variable growth model? Come on, people in the class, tell me. Everyone. Come on, come on, come on. People in the class, please tell me. Yes. So question 18th that way gets done. Question 19 is similar nature, easy question. We'll have to but do it in the class only. Let's read. Let's read as well as see the question on the timeline. Come on. An investor is considering, one second. An investor is considering to purchase equity share of LX Limited whose current market price is 112. We said fine. We have the current market price. The company is proposing a dividend of 4 for the next year. In the coming year, in the next year, the dividend is rupee 4. Fine. LX is expected to grow 20% per annum for the next 4 years. Sir, in the next 4 years, the growth is 20%. Now, by the word next 4 year, what do they mean? Do they mean next 4 year after the dividend of 4? Which means 4 is the dividend of next year. Do they mean next 4 year as 2, 3, 4 and 5? Is it? Or the next 4 year is 0 to 1, 2, 3 and 4. 20% is the growth for next 4 years. Is from 0 to 4 or 1 to 5? That is not clear. Correct? Proposing a dividend of 4 for next year, expected to grow 20% for the next 4 years. Okay. Growth will decline linearly to 16% per annum after the first 4 years. Sir, they made it clear that after the first 4 years, which means the growth of 20% was from 0 to 4. 0 to 4, every year the growth was 20%, after which the growth rate will decline to 16. Linearly decline to 16 means it will decline by some percentage every year. It will decline to 16%. Thereafter, it will stabilize at 16% per annum indifferently. So from 20 to 16, it will come down every year. But after it will stabilize to 16% forever, 16% forever. The point in the question to be caught is that, sir, examiner has not specified. From 20 to 16, it will come down in how many years? It can come down in 2 years, 20 to 18, 18 to 16. It can come down in 4 years, 20, 19, 18, 17, 16. Or it can come down in 8 years, 20, 19.5, 19, 18.5, 18, 17.5, 17. It may come down in 8 years. In how many years will it come down? The question is not clear. The reason for marking it pink is this. But through this ambiguity, I can teach you something very important which can be of use to you, not in this particular question, but in any other question. You know what is that? Do you know, people, what is that? Let me tell you. That thing really is what you look at it. Sir, if the examiner is not clear with the timeline at any point, you must make use of the present value factors if the examiner has given. Sir, what is the most general case of linear declines, and it will be 1% every year? So let me assume 1% every year. Sir, for the next 4 years, I know it is 20. For fifth year, growth is assumed 19. Then for the sixth year, growth is assumed 18. Then for seventh year, growth is assumed 18. Then for eighth year, growth is assumed 16. And then it continued to remain stable at 16. I am assuming 1% decline every year, and I have drawn it on the timeline. Now look at the timeline, figure out at the end of which year, if I stand and look at the future, I'll have a constant growth rate forever. In simple words, as per timeline, when should I calculate my terminal value, people? Sir, considering the timeline, it should be at the end of 7th year, because at the end of 7th year, if I stand, I have a forever constant growth rate of a 16%, correct? If the terminal value is to be calculated at the end of 7th year, which means I will have to manually discount the dividend of next 7 years and also discount TV7, which means I need the present value factor of 7 years, right? And if you observe, that's what have been given. With the help of present value factors being given for 7 years, I could crack it at my own that, okay, I need the assumption that I made of 1% decline every year is a absolutely correct assumption, and that's how I can now proceed to solve it. All the live and recorded people, are you please conceptually 10 on 10 to what I'm explaining? It'll be, although I can understand, difficult for some people who are studying AFM for the first time because it is too much of things to be processed in a single class. But let me tell you, it may be difficult but a blessing at this point, because otherwise we don't have a choice of any batch which can make you capable of attempting it in Gen 26 attempt. No other batch, literally. We are lucky that we got this opportunity to work hard. At least we will be capable of sitting in Gen 26 exam. You have to realize it. Yes. So boss, shall we proceed? Yes sir, now we proceed, except for understanding it on the timeline. This question had nothing new. Similar to how you had solved the previous question, this question you solve similarly, it is all easy. Dividend of first year is 4, which is already inclusive of growth rate of 20% of first year. Now for rest of the years, give the effect of growth as you see here. Directly on the calci, you solve it, and rounded off number you keep on writing here. For example, 4 plus 20% plus 20% plus 20% plus 19 plus 18 plus 17. You have the dividend till 7 year. For 7th year TV, you need 8th year dividend. So it is 7 years dividend multiplied by the constant growth rate of this divided by this. K minus G will give you this present value factor. You do DCF, you get a number of 114.97. The objective was to learn it on the timeline but not to solve it, because rest of it is easy. Question number 17, 19. Are you aligned? People. Question number 90th. Are you all aligned? Question number 20. We don't have to solve. Sorry. Question number 20th is homework. Question number 21, you don't have to solve. In fact, I feel we can try doing question number 21. It's really a good question. 22 is also good. 23 is something you won't be needed to do. 22 will be homework and 21 is what we do in the class. So let us very immediately go to the concepts notes to learn. The next situation. Sir, in case of variable growth model, whatever I have explained to you, where you have to first identify a point from where the growth rate is constant forever, do TV calculation, do discount rest of the things manually, was just one alternative. We have people one more alternative where we can arrive as the same value, and the alternative is now what I'm going to discuss. Sir, if I draw the same thing on the timeline again, 100, 10%, 15%, 9%, 8%, 7, dividend of 159.34, everything is same on the timeline. The concept will start now. Can you all in the class please tell me at the end of which year, if I stand and look at the future, I'll have a constant growth rate forever? Can you all please identify that point, that year end, where I stand and look at the future, I'll have a constant growth rate? Come on, please do it. You do it, you respond, then only I proceed now. People. Sir, at the end of 4 years, obviously, the growth rate forever is then constant. The logic of Gordon's models say that you can obviously calculate the terminal value at the end of 4 years that we just did. In fact, you know what is a hidden secret? You know what is the secret? You can also calculate the terminal value even a year before. Even a year prior to that year, you can calculate the terminal value. Meaning to say, everyone, you can calculate terminal value even at the end of 3rd year. But sir, how is it possible if I stand at 3rd year, the growth rate of 3 to 4 is 8% and then it is constant at 7%, then how am I able to apply the Gordon's formula? Sir, this is the detailing, this is the level of conceptual clarity that you attained previously. Should I go back to remind you? Yes. You must be wondering, sir, what are these pointers you are trying to specify? They don't look important, but now they will. Please tell me, growth rate from which point to which point does matter? Come on. From which point to which point do you all feel the growth rate does matter? Sir, when I calculate the value at 0 point, the first relevant dividend is D1 and the growth rate from 1 to infinity is what does matter to me. The growth rate from 0 to 1 can be anything. Do you all agree? Similarly, very similarly, if I stand at 3rd year, if I do apply Gordon's, if I calculate terminal value, the growth rate from 3rd to 4th can be anything. But yeah, from 4 to infinity, if this is 0 year, then this is 1 year. From 1 to infinity, the growth should be forever constant, meaning to say I can also calculate the terminal value at 3, which will be nothing but d4 divided by k minus g. What has this TV3 incorporated in itself? Sir, right from d4 to d infinity, everything has been incorporated and brought back to point 3. Everything has been incorporated and brought back to year 3. Yes? Which means now I have to manually discount dividend of 1, dividend of 2, dividend of 3. and the terminal value of 3. If these four things I manually discount and bring them to 0 point, I get the value of share again, which will also give me the same answer as this one did, subject to rounding of errors. Ignoring the rounding of the answer will have to be precisely same. This is alternative 2 of doing the same thing. But sir, what the hell are you doing? This is an exam oriented batch. Why are you teaching to us both the alternatives? If there is a choice, we could have learned only one. No, there's no choice. I'll tell you which one to be applied where. Before that, I want to learn from you. Are you people clear with alternative 2 of doing the alternative 2 of doing the value of share under variable growth model? Come on. People, come on. Tell me. Have you all started to find the things technical? But let me commit to you crystal clear. Yes. So let me take you to an understanding of when do you apply alternative 1, alternative 2. Sir, the question that we just did, examiner gave to me directly the information of dividend that for the next 4 years. Let me take you all to that question. Wait. Examiner clearly said that for the next few years, was that question, for the next few years dividend grow at this rate, after those years dividend grow at this rate. The growth rate of dividend was being given. Examiner did not talk about earnings, examiner did not talk about payout ratio. In the cases where examiner talk about earnings, examiner talk about the changing payout ratio whenever there is a payout ratio change happening on a future date. Whenever question talks about the change in payout ratio, sir, you have to, please everyone in the class, understand that you have to apply alternative 2 and not alternative 1. Even if the answer is same, we would want to follow the method which institute follows and whose answer has to precisely match even at the steps. At least the terminal value that institute calculates will be the same terminal value that we calculate. Even the final answer will be same, which is why I have specifically written here. One is preferred. However, we have to apply alternative 2 when the payout ratio is changing. Given in the question, the payout ratio is changing. For example, let us solve this particular question. Let's solve this particular question, question number 21, when the payout ratio changed. People, 21 question I'll explain directly. I won't read it for you. I'll just explain it directly. Listen to me. 21 question says what? It says that the earnings of the company were 9.6% dividend was 9.6 rupee, dividend was 3.48 rupee, sir, at 0 point when you stand, which is the year of 2014. Right? Now we talk about future years. They say earnings dividend grow by 20% for the next 2 year. Next 2 year earning grow by 25, dividend also grow by 25. Can I say it means I can automatically conclude the payout ratio for these 3 points have not changed because the growth of earnings and the growth of dividends are being same. Are being same. Payout ratio, people in the class will be payout ratio, people in the class will be constant, would have been constant. Fine. Then examiner says thereafter earnings will grow 10% third year and onwards. Sir, first 2 year it was 25. Then for third year and onwards it will be 10% of earnings growth. What will be dividends growth? Not specified. Further, when there is a reduction in earnings, dividend payout will increase to 50%. Sir, since the earning growth rate has been reduced from 25 to 10%, the dividend payout ratio after this point will decline to increase to 50%. Dividend growth rate was 50. Sorry, payout was 50. Now, due to decrease in the growth rate, the payout will increase to 50% then forever. Now, you all observe. To me, the growth rate of EPS is important or the growth rate of DPS is important? What am I discounting, the EPS or the DPS? That is the main thing a lot of students are not able to have the clarity about. To me, the growth that matters to me is the growth of my DPS. So if I ask you to calculate the terminal value, please tell me at the end of which year, if you stand and look at the future, you will have a constant growth rate forever. Sir, please observe. These 2 years the growth rate has been 25. Don't look at the EPS column. Growth rate of EPS doesn't matter to me. The growth rate of DPS matters to me. Please tell me at the end of which year, if you stand and look at the future, you will have a constant growth rate forever. Sir, these 2 years 25%, fine. But since the payout ratio is different, the 10% growth rate won't be there in this particular year. However, after this point, every year the growth rate is, the payout ratio is same at 50%, which is why the growth rate will also be same every year for dividends as earnings, which means at this point I can stand and I can say the growth rate will be 10% even for dividends every year. Earning growth rate become constant here, but dividend growth rate will become constant after a year, because in this particular year payout changed, hence the growth rate won't be same for earnings and dividend. Could I explain? This is the point where I can stand and look at the future to look at the constant growth rate in my dividends. People, please validate if you are able to connect to my thoughts or not. Yes? So please tell me, everyone in the class, please tell me, at this point, if I stand and look at the future, I have a constant dividend growth rate, which means I should ideally be standing here. But what I have to follow is the alternative 2. If I want, I can stand a year back. I said, whenever there is a change in the payout ratio, I stand here, I'm trying to figure out whether I should apply alternative 1 or 2. So we say that wherever there is a change in the payout ratio, in the future years, you will have to apply alternative 2. Which means, do you all agree that I should not calculate the terminal value here. I should calculate the terminal value 1 year prior to that, which means at the end of second year. Come on, everyone in the class. For TV2, I need the dividend of third year. All the dividends from D3 to D infinity will get incorporated in TV2. So all I will have to manually discount is dividend of first year, dividend of second year, and terminal value of second year. These 3 things, if I discount manually, what I'll get? I'll get the intrinsic value at 0 point, which is what I want. How do you do it? I am yet to teach, but what will you have to do? Are you clear? How to do? I am yet to teach. People in the class requesting a response from every live and recorded people sitting here. Sir, is this chart driven approach, timeline driven approach adding value to your knowledge, value to your understanding, clarity to your concepts? Come on. Do you agree that when you draw it on the timeline, these are the same charts that a regular batch student, we draw it in the class. That's how we learn it in a regular batch. Tell me. Come on. Are you all please understanding? Yes. So now let us learn. Sir, dividend of first year I have added the growth. Dividend of second year I have added the growth. Dividend of third year. Sir, you don't know the growth. You cannot calculate D3 directly from D2. This is a very clear message I want to tell you. Whenever there is a change in payout, you can never directly calculate dividend of next year, because you don't have the growth number. Yeah, the growth is not same as earnings. It is something else only. It relates to which particular concept in the outnotes. Let me show you here, sir, here. Everything that you read has a further advanced level implication. That's what I was trying to teach here. Payout changed from 50 to 60. Which brings to me to the conclusion that the growth of earning will not be the growth of dividend. Fine. But can I directly calculate the growth of dividend? Primarily, no. It's not impossible, but we don't have to do it directly. How do we do it? We go by way of earnings. We know that the earnings are 110. So earnings grow by 10%, making it 121, of which 60% gets paid out, give me 72.6 being the dividend of second year. If there is a change in payout, you calculate the amount of dividend by way of earnings and payout. Earnings growth and payout, not directly. Which is why, if you realize everyone in the class, which is why, one second. Where's that question? Which is why, people, if you realize, what do we do? You check this out. We have to, in this scenario, calculate the dividend of third year. Calculate the dividend of third year. Not using the dividend of second year, but using the earnings of third year, and then apply 50% payout ratio to it. You know what is the impact of it? The impact is really simple. Sir, whenever there is a change in payout ratio, if you look at the tabular solution, you will have to create two more columns. One column for EPS, another column for payout. Two more columns you will have to create, because if you directly draw the cash flow column, you'll be stuck, because after a point you cannot calculate further dividend using previous dividend. What do you have to have? The EPS. So what we say? We say that the sir EPS of first year is 12, 9.6 plus 25% is 12. EPS of next year is 15. DPS of next year is 4.8, DPS of next year is 6. That is fine. What is this DPS? You can't directly calculate. You will say 15 rupee EPS plus 10% growth rate, 15 into 1.1 multiplied by 50% payout ratio, multiplied by 50% payout ratio. This is the dividend of 2017. This is the dividend of third year actually. Using the EPS, we are calculating DPS. EPS of 16, yes. Multiplied by the growth rate of 10% in EPS, yes. Multiplied by the payout ratio will give me the DPS of everyone in the class. D 2017 it will give me. And this dividend of third year, which is 2017, divided by K minus G will give me the terminal value of 2016, which is my second year end, K being 15%, somewhere given in the question where it is, yes, sir, growth forever being 10%, G is 10%, and that's how when you solve, you get the terminal value at the end of second year 165, cash flows of first and second year 4.8 and 6, discounting everything gives you 133.45 as the final intrinsic value. Boss. Could I not only teach to you alternative 2, but also how do you apply that particular alternative by first of all imagining everything on the timeline and then do the solution. Boss, what do you all say? Are you all please there able to connect to what is going on in the session? Question number 21, people in the class gets done. Please share your comfort or discomfort on this particular question. Waiting. Come on, people, waiting. Done. So that's really great. Question number 21, people in the class, gets done. Question number 22 is your homework. 23 you don't have to do. 24th you don't have to do. 25th is a question which should be done in the class mostly. 25th is the question to be done in the class. Yes, but it requires quite a different thought process. All right. What do you all say so far? Are you in a state of mind to learn more things, or you are already settled for the day? These being the initial lectures, I don't want to make it heavy right from day one. I want to first make you capable of such intense lectures for 2-3 days. What is the state of mind? Are we able to? Are we in position to learn more or maybe solve more questions? What do you all say? Everyone in the class? Or maybe all the similar nature of things have got over? We can consider to solve further questions from next class onwards and obviously learn new questions. So till question number 24, we are all done. Either you have to do it at homework, either we have done it in class, or you have to leave it. 25th onwards, we'll do solve the questions in the next class. Now the next class will be tomorrow. Tomorrow onwards, the lectures will be regular unless it is some holiday that we take. But yeah, generally saying they will be all regular now. Yes, everyone? Are we all fine? Are we all set with it? Great. So that was all, people in the class, for the day. You have learnt further models and dividend discount model, right? Further questions will solve in the next class. In the next class, we will in fact move to the further models like cash flow based valuation models and everything, right? So thank you so much, people in the class, for joining in. Let's meet back again in the next class, which is tomorrow, same time, where it'll be for 3 hours now, every day, or maybe 3 hours plus 15 minutes, depending upon how we do it. All right. So see all people. Bye bye. Take care. Thank you so much for watching up this lecture. I would request to share your genuine feedbacks in the comment section of this video. If you did like the lecture, kindly put up your genuine feedback in the comments. Alright, all the live people watching it, kindly do it after the session ends. All the recorded people, please do it. Thank you so much. I'll see you again. Take care. Bye bye. Bye Surya, bye Aksha, bye Atulya, bye Sarvendra, bye everyone else who's here. Take care, people. See you all. Bye.